Hey, Tyler.
Yes, Jason.
Ford's looking super cheap, and that dividend yield, almost 8%. Looking awful spicy right now.
Even with your and I's history of not being a huge fan of the automotive industry, when you look at something that cheap, even my ears are going to perk up.
Yeah, 83 cents on the dollar against book value, 7.98% yield as we record this right before the market opens in mid-April. So definitely looks compelling, but there are some real risks investors need to think about here. We'll talk about Ford, the risk reward opportunity, but we've got some ideas. Whether you're looking for a predictable high yield, something that's maybe safer, or maybe an alternative kind of turnaround risk reward play where I feel like the dividend is also probably safer than with Ford's. You ready to dig in?
Let's go.
All right, everybody, we've got a couple of great stocks to talk about right here, but our sponsor, The Motley Fool, that sponsors this video, has some pretty great stock ideas too. If you're looking for more great stock ideas, go to our special link. It's fool.com/unscripted. Go to fool.com/unscripted. You can get access to The Motley Fool's 10 best stocks to buy right now. All right, Tyler, let's talk about Ford first. What's the backdrop that is sent the stock price down, pushing the dividend yield up, the opportunity, but also the risks? What are we seeing right now?
Well, there's the obvious one in headlines today, and that's tariffs. You can't go to a major news website or read a newspaper these days that talks about tariffs and the implications on products like automotive, because automotive is one of the things that's going to hit the hardest, not just from the most recent round, but the earlier rounds and how those are going to affect supply chains for automotives to pass on very large costs to customers or taking a bath on, current products, which are, let's be real here, automotives, they aren't the highest margin business in the world. And so you have a capital intense business that's relatively low margin, and all of a sudden this whirlwind of tariffs is going to throw it into a challenge. Even before we got to tariffs, I don't want to call it the straw that broke the camel's back, but even before that, Ford wasn't exactly, knocking it out of the park. It did make a pretty ambitious push into electric vehicles. The uptick on that has been less than expected, and they've had to pull back on that, at the same time trying to navigate the intricacies of having to manufacture EVs and manufacture its existing fleet of F-150 pickup trucks, the most popular vehicle in America. You can't just start making EVs when you have a 3-week downtime at your F-150 plant. It takes a lot more than that. So you have this challenge of idled capacity, and all of their capital deployed these days wants to be going into EVs to build this out when it hasn't been growing as fast as possible. So you have these kind of dual challenges going on where it's like these businesses trying to make huge transitions. And now that in the midst of making this huge transition, its supply chain logistics and everything is getting blown up and they need to reorient it.
Yeah, that's right. I think we also should throw interest rates in there too, because it's not just houses that have gotten a lot more expensive because of rising interest rates. It's affected Ford and automakers as well, because they do a lot of their own financing, but they still have to get capital, which means if you want to offer that low rate to a car buyer, you might have to be subsidizing some of the interest rate with your capital partner, which is going to affect your bottom line. Definitely being hit in a lot of ways. I want to hit on the tariff thing just a little bit more, because it's easy to look at the most recent tariff story, which is the 25% tariffs on cars imported into the US, and think, well, hey, that should be good for Ford, but forget about the prior first round of tariffs with our border partners, Canada and Mexico. Over the past 3 decades, we've seen the auto manufacturing infrastructure and the supply chain stretch across borders. And cars that are made in the US rely substantially on parts and components that are coming from those imported in from Canada and Mexico. Now the duties from those tariffs are substantially raising costs for Ford, like you talked about. Plus, one of the other first round of tariffs that was put into place on foreign imported steel, even though a lot of the steel Ford uses is produced domestically, those prices went up as soon as tariffs were put in place on imported steel, because steelmakers raise prices when tariffs are placed on imported products. Ford's getting hit from all sides right now. Now, again, there's risk reward opportunity here. The stock trades for around 83% of book value at recent prices. Historically, it's traded closer to 1.2 times book value, has been a pretty good, reasonable price. So that's a lot of upside from here. If you think about it, that dividend yield's around 8%. You think, hey, that's a great yield I can lock into. I want to acknowledge that risk reward opportunity is there. There is some deep value potential that is there. Number one, if we go through a protracted period of economic weakness and tariffs that are putting pressure on Ford both on its costs and then on prices. That's less left over for it to fund not just its ambitions, but just regular upgrades and maintenance of its own factories. So it's getting squeezed on both ends of its business a lot. Now, again, that deep value play can work out over time as things return to some level of normal, whatever that looks like, whether it's exactly the same as it was 6 months ago, or it's more in line with what the Trump administration's vision of manufacturing in the US is. Somewhere in between that is what Ford's going to look like on the other side. And there's probably value from this price. Let's talk about the dividend though. Yield is 7%, 7.8%. Let's talk about the dividend though. The dividend yield's almost 8% at recent prices. How safe is that dividend really though?
There's two components to it. So let's break it up, because Ford doesn't pay just a quarterly dividend. They also often pay an annual special dividend. Its current dividend yield is reflective of that most recent special dividend. Anybody looking at the price today, it is inflated a little bit. If you look at its forward dividend yield, so its expected dividend payments in the next 4 quarters, it's actually a little bit closer to 6.5%.
Those little spikes, this is when the company has paid those special dividends in the past. So that's a critical part of this story, Tyler.
Number one, we'll reset our expectations and say that this isn't a 8% dividend yield company. This is right now a 6.5% dividend yield based on its projected quarterly payments. So 6.5, still compelling, especially like you said, is 0.8 times book value. So it's basically trading for less than the value of its factories in a liquidation event. So you squint hard enough, there's a lot of value here. I mean, it's trading for single-digit earnings, but I feel like automotive companies have been trading for single-digit price-to-earnings ratios for, it seems like, the last decade plus. So that's more or less in line with what we've seen here.
The bottom line is that the trajectory that we're on, that trailing earnings ratio of this earnings are going to come down, right? It's almost guaranteed earnings are going to come down.
When you know that earnings are coming down, your trailing earnings multiple is likely going to be low. But here's one thing to keep in mind with the dividend. Even though it is 6.5%, this is a company that has not been afraid to cut its dividend when it needs to for various reasons, whether it be because it needs to, it cut its dividend a couple times during the 2000s because it was trying to retool a lot of its manufacturing, refresh its lines, trying to figure out its role in manufacturing in the 2000s, because we went through a period where prices for oil were really high and everyone was going away from SUVs, going towards smaller vehicles. Then 2014 rolled around, oil prices fell through the floor. Everybody wanted SUVs again. Big vehicles, trucks became in vogue again. Ford had to refresh its lineup. Internationally, it's always been a challenge for them, whether it be in China and other places. They haven't been as profitable. Management, and specifically the Ford family, because they own a lot of shares and direct what the dividend is going to do, have not been afraid to cut the dividend. And they've done so many times. In the 2000s, they did so during the coronavirus pandemic. This has been pretty indicative of the company.
Right here, we see that right here on this chart. I think that's really important to remember, is that we do know at times management, like you said, because your largest shareholder, the founding family, has been willing to cut the dividend when necessary to focus on making sure the business remains solvent and doesn't go through a GM bankruptcy sort of situation where all of a sudden you're not the owners anymore.
Yeah. So maintaining ownership and control is paramount to getting a paycheck from the dividend yield, which there is some assurance in that to a certain degree. But if you're looking for reliable income month to month, quarter to quarter, Ford has over the past 10, 15 years proven that not necessarily is the best case. It would not be shocking in the next couple of quarters if tariff costs really bite into this company that they do elect to suspend the dividend for a while until conditions improve.
Well, let's do this. I know a lot of people watching this video are looking for a stable dividend, something that they can count on as being safer, far less likely to get cut, and actually far more likely to be raised on a regular basis, but could still offer a high yield. So we're going to step out of the automotive industry here, but what's a stock that you think is great, backed by a great business that has a high yield now and can more reliably grow that payout over the long term?
First, we're stepping out of automotive because I think you and I agree it's really hard to find a stable, reliable dividend paying at a decent yield in the automotive industry. And that's why we're going out of it.
And this business is, this environment that we're in is unique, but it's not unique for the auto industry to go through periods that the implications are the same as this, where their businesses are going to struggle, margins are going to get crushed, and their ability to continue to pay a reliable high yield payout is very, very low.
Yeah. So Jason, you're going to smile when I say this one, but I'm going to actually go with Brookfield Renewable Corporation. This is one of the Brookfield entities. It owns all of its renewable power business. We could go into wind, solar, the growth opportunities, some of the deals that it signed recently with AI and all that stuff. But what matters the most when it comes to the reliable dividend component of Brookfield and Renewable and most of the Brookfield entities is that management seems very focused on buying quality assets at low prices that are going to generate stable revenues and are, I use this term a lot, but underwritten in a way that they're going to be profitable even in bad case scenarios. They don't take on too much debt. They tend to buy at good prices, and then we'll call it like the tune up of the business, whether it be like maybe fixing the wind turbines, repowering wind turbines, or releasing new contracts for its solar farms. They do a very good job of underwriting the deal to get a good rate of return on it that allows them to grow dividends over the long period. What is it, like 10, 15 years that Brookfield Renewable Partnership has been around? This is a business that has grown its dividend more or less in the 5 to 7% range annually for more than 10 years. And while interest rates going higher could be a challenge for them, going back to the underwriting component, it seems reasonable that management can find a way to continue to grow this business at that rate and still pay its current yield, which right now is 5.6%.
Let's do one more here, Tyler. I agree. This is Brookfield Renewable. You and I both own stable, reliable, growth-driven business. But sometimes investors are looking for a little more risk-reward opportunity, and yield might be part of that idea, but are still looking for something that could have a little more potential to generate a higher level of total return. In the vein of a Ford, where you're looking at it being deeply discounted and that being the opportunity, I think an interesting, compelling one right now is UPS. So I own UPS stock, a relatively small amount that I've added based on it being, I don't want to say it's a turnaround, but it's kind of a refocusing of the business. I want to share a slide from their most recent presentation from their Q4 earnings and a few things that they're doing. Number one, they're growing some global parts of their business, doing more business with small and medium-sized businesses, but they're also shrinking other parts of their business as well. Closed 49 locations, including 11 permanently closed buildings. What they're doing is they're stepping away. As I think most people know, they're stepping away from their deal with Amazon. That's going to really drag out over the next couple of years, divorce away from one another. As we know, Amazon is, of course, trying to do more of its last mile internally. UPS says, look, this is a low margin business, and we're with a partner that's trying to leave us anyway. Let's move on. UPS has accelerated that. They're ripping the bandage off to accelerate it, shrinking the business in these lower profit areas, and really focus on areas where their logistics network and their speed to deliver creates value in areas of logistics where the premium can be earned. Here's one thing I mentioned on a few other videos that just I think is exemplary of what they're trying to do. Their Louisville hub, where it's such an important part of their business, they have a testing facility set up for medical testing. For quick turn medical testing, again, an area where there's value, this is something that UPS has started to do and where they can start to get more margins. As they grow out more of the lines reflective of that sort of thing, where there's growing demand and there's opportunity to make more money than in some of the more commoditized parts of the business, it's going to take time to play out, and it's not going to happen quickly. And again, things are going to get probably a little worse for the business in terms of the financial results before they get better, but it does make for a compelling turnaround because the stock is down a lot. It trades for mid-teens earnings valuation, the dividend yield 6.9%. So this is about as high as you've seen the yield for UPS in its history, far higher than it's been. The company's in a different state than it's ever been for its business. So it's going to take some time for the turnaround to play out. There is some risk that the company, if it doesn't execute well on its strategy and its revenue and earnings fall more quickly than they can bring other parts of the business online to replace those lost earnings, that at some point they may have to lower the dividend. I think that's a low probability. More likely, maybe the dividend just doesn't grow very much for multiple years. But if you're looking for a risk-reward opportunity, I think UPS is a far better bet than Ford is right now.